Hi, everyone, and welcome to this week's edition of Feeling Smarter. Once again, I'm joined by Tim. G'day, Tim. How are you?
Aaron, going super well. How about yourself?
Very well, thank you. Well, last week we had a huge number of people obviously provide feedback on this introduction of our Div 296 measure. Today, we're going to continue that conversation where we're going to focus on the concept of associated earnings. And Tim, we briefly touched on this last week where we noted that the definition around total superannuation balance has changed. So I might get you to just elaborate a little bit further on this amendment.
Yeah, look, and again, it's something that came out through the consultation period with very little sort of additional information or what ifs associated with it. But it's this concept of when we're calculating the earnings, because we know that it's calculated based on starting total super balance versus ending total super balance. And so what they've introduced is this concept for the end of the year, which is your adjusted total superannuation balance, which incorporates your actual total superannuation balance. It then subtracts any contributions made during the year, and it then adds back in any withdrawals for the year. And so, you know, by factoring in the minusing of the contributions and the plussing of the withdrawals, it's effectively saying, okay, well, if we take all these things into consideration, it gives us a more realistic position as to what growth the funds have had. No, not excluding the issue associated with unrealized gains that we all believe is a massive issue here, but they're saying that this gives us a greater idea or a capacity to determine what the earnings are. But what it has done, or what it's created, is created a clearer definition of what meets some of these things, such as contributions and withdrawals. And along the lines, I've sort of noted that there are a few issues that can probably be captured under the how did they let that slide in kind of discussion.
Yeah, so when we think about the withdrawals and the contributions thing, we've almost got our transfer balance account debits and credits happening again, haven't we? Because in essence, we've got to go through and we have to make the adjustments for pension payments, lump sum withdrawals, amounts for family law, contribution splitting, and so forth. And then on the flip side, we then need to look at those same things again when we think of contribution splitting and family law, because it comes out of one, but it goes into someone else. And then we're looking at things like the impact of contributions that have gone in, whether they're non-concessional or even concessional. And therefore, interestingly, that they talk about 85% of the amount of the concessional contribution. Now, interestingly, I think a lot of these people are also going to fall into the Div 293 category. So I'd be quite intrigued as to whether it ends up at 70% or whether it's at 85% from a concessional contribution point of view.
Yeah, and looking at, and I think that's sort of one of the things that's been whirling around my mind. And one of the things that in line with that Div 293 concept is that under the withdrawals definition, it talks about the Tax Administration Act and the various release authorities under Div 131 of the Tax Administration Act, and that those release authorities will be added back in as a withdrawal. So, of course, that is our excess concessional, our excess non-concessional, our Div 293, and then by extension also the First Home Super Saver scheme. Now, what's really interesting to come out of this measure is that they have gone to an extreme length to exclude the associated earnings calculation linked with First Home Super Saver scheme from this calculation of earnings for the $3 million total super balance element. Now, what's a bit ironic is I suspect most people with more than $3 million in super would also not fit into the category of first home super savers. So while they've gone to that extreme is questionable. Whereas what is included is clearly the associated earnings linked with excess non-concessional contributions. So we've got this amount of money that has been legislated as representing money that should have been earned outside of super, not inside of super, which has been forced out of the superannuation system through the release authority to be taxed at marginal tax rate, to then subsequently be added back in to be taxed at an additional 15% for those with more than $3 million. So something's not quite right there.
And obviously, the enormous amount of time we have to provide feedback, tongue in cheek, 2 weeks. These sort of things is the very reason why we actually need consultation and a period of time for consultation. It allows for these type of matters to be fleshed out and obviously looked at in much greater detail. And one of those areas, Tim, is of course around carry forward negative super earnings as well. So I know the SMSF Association has been quite resolute on this issue insofar that we do have a number of superannuation funds that will invest in startup entities and other entities that might have significant fluctuation in asset values. And they can end up in a situation where in 1 year you might create a liability, but in a subsequent year you could end up in a negative position. And ultimately, what we're going to see here is that ability to carry forward that amount will apply as had been previously indicated. But ultimately, whether someone can utilize that loss in the future or that negative earnings calculation becomes the big question mark. And there is no transfer of that upon the death. So in essence, it means as if you have a negative balance that is carried forward, when that individual dies, that loss dies with that individual as well.
Yeah, well, that's right. And this is the thing, isn't it? I mean, you can be accumulating these unrealized gains, pay the additional 15% tax, then you can get to the point where you actually realize some of these gains, but you're not realizing gains, you're realizing losses because of movement in the market, and there's no clawback facility. So you've effectively paid tax on a paper gain, not on a real gain, and that's one of our big issues from an industry point of view.
Absolutely. Well, thank you once again. I'm sure we are continuing to flesh out a range of these issues as we explore the Div 296 requirements. Our next session, once again, we will be looking at this topic, but focusing on the exclusions of when Div 296 is payable, because we have seen a number of areas that are quite interesting and no doubt will be impacting your clients as well when it comes to self-managed super funds. So Tim, thanks once again for joining us for this week's edition of Feeling Smarter.
No problems, Aaron. Look forward to speaking to you next week.